It is a bit late. So as I then said, it's all going to be recorded on YouTube. So I had a recording on YouTube just now because we are going to put that on our website. So I won't repeat what I've said, so you can go on YouTube and you can listen to my speech there to save time. Right, so I know you're very loyal and consistent in your search for the transparency that this bank wants to practice. And we have at last been able to find the rare bird that we were looking, right? For the last 2 years, I've been carrying a cross here, and you know how heavy that cross has been, right? With not an albatross, but a flamingo around my neck. And you know what it is to carry that flamingo. And my biggest regret is that we have not yet been able to bring to task those who have brought that flamingo in this bank. And that would be the crown, you know, the jewel in the crown of my passage here. If we are able to bring to task all those who have bring to this bank and bring into being that flamingo. So for 2 years I've been carrying this I won't say deadly, it is a deadly and fearsome bird around my neck. And hopefully I've been promised again by Raj. I thought Raj was going to do a much better job than that, thankfully, because the other one before him, every time he said, it's done. Chair, it's done. Next. You'll get your digital banking. You'll get your... So fortunately, you know, we did not buy into his game. And we brought in Raj. And I told him, you know, you should get this done within the next 3 months when you're here. Because for the past year, during which I was chairman, I was every day promised that it's being done. It's being done, chair, it's being done. We are going to be better than MCB. Nothing happened, and Raj came in. I said, at least, you know, I give you 6 months. But after 6 months, we are still in the process of trial and error. So now the challenge is on this one now. Andrew, right? So I hope that finally we will have resolved all the problems of Flamingo. So I'm told that end of April, our mobile and internet banking will be on full stream and fully functional, right? So I hope I'm able to see that promise kept next month.
Next month.
But I give you another month, you know. Backsis, I give a backsis of 1 month, right? If we're able to achieve that, right, it will mean that the biggest battle that we have to win will have been won, this IT system. The second big problem that we have, as you know, at the bank, is the problem of staff retention and staff recruitment. You know this. I don't need to hide anything. Most of the people sitting here, whether they are working with SWAN, or they're working with MCB, or they're working with any other organization, must have had a stint of training here. This is known to be a good school for other financial institutions, right? But I think now we have been able to sort out our problem. We have ended this employment by contract. We have given the salary raise that put us, you know, in the forefront of the competition. And we have also set up a staff academy, a training academy for our staff. So I think we will have stabilized our human resources after stabilizing our IT system. And on top of that, the creme de la creme is we have got Andrew Bainbridge as Group CEO. This guy, the expectation is so high on him, right? And I know, in any case, it is my feeling. I know also you share it, because the bank, for a long time, has been reeling under this BAI saga, right? Especially the public statement of one very senior level person who said that he will ask SBM to take over one bank, right? So this has did tremendous harm to the bank. You will have seen that for a long time after this event, we are not having any type of public statement from the decision makers on the SBM. We have quietly resolved a lot of our internal problems, and we are projecting a much better image of a public listed institution which is doing everything to establish itself as a trusted, transparent public institution. We are there, but I know there's a lot of skepticism also. So that's why our share price is not a true reflection of what the potential of a bank is, or of what the bank is actually transforming itself to be. So I will pass it now to Andrew, our Group Chief Executive, to give you the financial snapshot of the bank, but also I will ask him to use the advantage of his former position as the Barclays Africa MD and the, how do you call that? The Western Hemisphere Chief Risk Officer of State Standard Chartered Bank, use the vantage point that he has as an outsider to tell us his constat, what he has seen in the bank, what is the potential of the bank, and what he thinks is the future of the group in its new strategy of expansion and growth. So Andrew, I'll pass it on to you. Thank you.
Thank you, Chairman. Good afternoon, everyone. I'm not really sure where to start, having been called a rare bird for the first time in my life.
Not flamingo, eh?
I'm not a flamingo, apparently. So every cloud has a silver lining, as they say where I come from. I like to think I'm a realist, so let me start by disappointing my chairman in 3 areas. First of all, he says there's a great deal of expectation of me. To be clear, without our nearly 2,000 colleagues, I will achieve nothing. So SBM is not about one person, it is not about a few people, it is about aligning all of us to achieve a few relatively simple things, because sadly, as my father told me from the day I took up this career, banking is a pretty simple profession. Secondly, I am delighted that we are finally going to have a great internet banking channel for our retail and corporate clients. And I know our corporate clients have been enjoying it here in Mauritius for a few weeks. It is not the end of what we need to do on IT. It is a step forward in terms of client service delivery channels. We still need to work hard in the coming years to drive the value of the very large spend on IT that we have made in the past, and make sure that we make that productive for our clients and for our shareholders and other stakeholders. And thirdly, I think moving our staff off contracts onto full-time employment is a great step forward. But it does not by itself make us employer of choice. Getting the right culture, the right working ethic, the right way of treating each other, and having the right values as an organisation throughout the organisation every day is what will complement the work that's already been done to make us an employer of choice. And that's where we want to go in the years to come. So I see from the timetable that I've got an hour to take you through some relatively simple financials. My intention is to spend a lot less than that, have more time for Q&A. And between us, the four of us here, and the colleagues that we've got in the audience, we should be able to answer any question you ask, which is probably the most stupid thing I'll say today. But we do want, as the chairman says, to be transparent. We want to be able to have a dialogue with you, not just a show and tell PowerPoint. So with that, let me see if I can get through the show and tell PowerPoint at a record speed. That's the standard disclaimer. If we were an IT company, there'd be a little box at the bottom that you tick to say that you read it. Financial highlights. So, look, anyone who's looked at our results knows that we've grown assets very fast over the last couple of years. And to some extent, you could characterize that as risky because we've grown the assets in the loan book, or you could characterize it as catch-up. I think I would characterize it as catch-up. And I have no skin in the game to say that because, of course, I'm new here. But if I look at it and I look at our market share in segment B at just over 10% on the latest stats that I saw last night, we are not going out and trying to take every piece of business that's out there. We're taking sensible business. And we will be doing a review as to where we've come from and where we are during quarter two to make sure that remains the case before we continue to grow at the same pace. The thing that I am particularly delighted about, and you have to bear in mind, I've had absolutely nothing to do with these results. I arrived 8 days after the year ended. So this is down to my colleagues here and my colleagues out there and across the country. What I'm particularly delighted about is that deposits have grown and fully fund the loan book and then some. This is not a risky bank. This is a very safe bank, and I can see PV, our head of financial markets, aka treasurer, nodding at that point. Because for me, having a decent loan deposit ratio and being fully funded this way is really important when times get hard. And times aren't hard now, but I like to have what JP Morgan Chase calls a fortress balance sheet. When it gets difficult, you're the people who are left standing, and then you can take opportunities, and that's where I want us to be. So we grew deposits, we grew assets, we grew total liabilities, we grew PAT by 11.5%, and we put just over 1.3 billion rupees more into shareholders' equity in terms of retention after paying dividends. So that's pretty good as a headline set of figures. I'm pretty happy on behalf of my colleagues, and I'd like to say thank you to all the people in SBM who delivered that. If we look at net interest income, it grew. We'll talk about a little bit more later about the net interest margin, how that's narrowed a bit, how we've grown income slower than we've grown advances, which is inevitable because income is a lag effect from advances growth, but also because of the different balance sheet mix that we've been growing over the last year. Non-interest income grew faster than net interest income, a good sign, and we'll show how that splits later on. And then PAT, as I say, up 11.5% on the previous year, so well done. We've got a lovely bar chart here. It doesn't really tell you anything I haven't already told you. Apart from you can see the jump from 15 to 16, you can see the progression. Our challenge now is to carry on that trend and accelerate it further. So let's talk about how we got from 16 to 17. So net interest income up just under 9%, non-interest income up 36%, and as I said, we'll decompose that in a couple of minutes. Non-interest expenses up 24%. That's partly because we have a new bank in the family in terms of SBM Kenya, which added to costs, but also the work that Raj and the chair and the team have done converting people from fixed-term contracts to treating them properly and putting them on permanent employment. That increases our cost base. There is, of course, as the chairman has already alluded to, an IT cost in there as well, and we will further talk about that. There's a portfolio charge which is up a lot, and I have no doubt that we'll get a question on IFRS 9, which has become my favourite technical subject over the last year and a bit, but we'll leave it till then. And we had an increase in specific provisions, and that's an increase from 16 to 17, and that's down to a few clients in the portfolio. So it's not a widespread issue, it's not a pervasive or endemic issue, it's a few what I'd call legacy clients. And I will have Shailen from the front row scowling at me if I say any more in terms of detail, but I'm sure there'll be a question on that as well. And that's pretty much it. That's how we get those, the major moves. So grow the loan book, do the cross-sell, treat your staff better, swallow the IT costs, and provision things appropriately is the story of what happened last year. And that's the story, to me, of how a commercial bank should look. So, return on equity continued to recover. Not as much as we initially hoped for and set out last year, but I think you can put some of that down to the impairment story that I alluded to a minute ago. Return on assets dropped, and again that comes down to business mix, and we'll talk a bit more about that. So when I talk about business mix, what do I mean? Well, if you look at this, deposits grew, as I said, net loans and advances grew, total assets grew. But it's actually significant growth in segment B that has driven the net loans and advances growth. And segment B dynamics and currency are quite different to segment A. It's foreign currency, it's narrower margin, and the challenge on Rajan that the team is very much to prove that we don't go into segment B just lending, and Rajan and I have talked about this many times, but we do the cross-sell and we get the liabilities that go along with doing that business. Now we know there's a lag with the cross-sell and liabilities, so a lot of last year was about lending, a lot of this year is about proving that we've built relationships and that we're not just transactional in this space. So, as you see the mix of segment B assets filtering into the book, you get a lower yield on the advances. And that's been kind of exacerbated a little bit in the domestic market by the excess liquidity that we've all seen. Yield on... Sorry. Bless you, sir. Yield on investment also declined, but it's not significant compared to how we do on advances and cross-sell. This is a slide that I'm delighted by, and frankly, I hope all our shareholders are as well. It shows a really well-diversified deposit book. As I said, we've grown deposits solidly by a higher quantum, although not percentage, but a higher quantum than we've grown loans, which means we've kept our highly liquid position. And as this chart really proves to you, we haven't done that by shifting the mix to a particular form of deposit. We've done this by keeping a stable mix, and that's a really great achievement. So I think we all owe a vote of thanks to our colleagues in retail and our colleagues in corporate domestic as well who've achieved this. And for those of you who do comparisons, and I don't, so I'm told this is true, we have the best cost of funds in the marketplace. So we've kept the mix, we've grown the deposit books, and we've kept the lowest cost of funds. And that's a pretty good achievement. So again, our cost of funds improved slightly. I mean, if you were to do the math and disaggregate it, you would see we have a very low cost of funds in the domestic market and obviously slightly higher in international, but getting the mix of foreign currency deposits is helping us on the international side as well. So that's good. Our net interest margin has narrowed by 30 basis points. And really, to be honest, with where we saw growth coming from, we probably should have telegraphed this a bit more than we have. I think this will start to recover again a little bit as kind of global rates go up and we can kind of stretch a bit. But if you're going to do more dollar-based lending, you're going to see this happen to what has traditionally been a higher margin domestic book. So I'm not surprised, but it's one of the things that we will be keeping an eye on in 2018 and beyond. So we grew the assets, and we grew the net interest income. As I say, there is a lag effect, obviously, because we measure assets at 2 points in time, and the interest income accrues through the year. So you'll start to see some catch-up this year on last year's asset growth. Now, I promised to decompose the non-interest income. So you'll see the standout, well, I hope you'll see the standout performance here is actually the trading income, where we saw a 112% increase over the year to the 31st December. That reflects the increasing range of instruments traded within our financial markets division. And when I got here and I was shown these figures, I got a little nervous. If you have a background partly in risk management, that's what you do when someone shows you good figures, you get a bit nervous about it. But I looked at this and I thought these products are not exotic, they are not taking principal risk, and they are well managed. So it's a great result on that line, but it's a great result without taking disproportionate risk, which makes me much more comfortable. So going back to the top, net fees and commissions, increasing 18%, good progress. I'd like to see that continue, and maybe if we get the crossover right, we'll see a little bit more increase in that. Dividend income, there's one big stock in our portfolio where we haven't received dividend for a couple of years, and we aren't counting on it, and it's not a major component of this anyway. Trading income we've talked about, and then other income, so e-business. As the chairman reminded me on Thursday, this is a mixed business in some ways. There's a legacy Visa, MasterCard, offshore point of sale business in there. There's a strong onshore point of sale and an issuing business. And then there's the new business in terms of new channels. You saw the launch, well I hope you saw the launch of us being the Alipay provider here in Mauritius. So that's got some businesses which are structurally in decline due to the changing nature of the financial sector and financial regulation. You've got other businesses within there which are green shoots which are coming up to take over that income momentum and growth going forwards. So that's quite exciting. So you add all that up, then you get to gross operating income growing by 17.5%. As I say, that leads to a profit after tax growth of 11.5%. And you can see the split there. Right, so this is the change in the non-interest expenses. You can see personnel expenses rose by 220 million. That's the contract mix, that's the annual pay rises, and it is also new staff in terms of Kenya, the new bank that we have in the family. You'll see the growth in other expenses, and we have IT within that. Last year was the first year of full amortization of our investment in IT, plus the first year of the full operating expenses of the new IT system. And that's something that Raj and I are working on, how we keep that under control, and as I said earlier, how we drive efficiencies out of it later. So that's a chart that I think the chairman will probably stick in front of me fairly regularly and say, how's it going today, Andy? It's interesting, he didn't tell me about his rare bird before I turned up here, though. I did say to him, how's everything? He said, oh, you've got a great new IT system, Andy, it'll be wonderful. So our cost-income ratio went up last year. And that's, as I say, partly IT, partly depreciation and amortization of IT, partly people and doing the right thing, and the increase that is due to people I see as a solid investment, because that's actually treating our people the way we should be treating them. And that is a really big shift in terms of culture and how we look after people. That builds the loyalty. That means that in the years to come, hopefully we have fewer of you in this room who have worked at SBM and then left because you didn't feel wanted, and more people who are here because they enjoy being here and they like the culture. So that's an investment. The piece that isn't in the same way are kind of extra costs relating to channel proliferation. Because we are providing more and more channels, we need to make sure that we're managing that channel mix really well. And Shailen and his team have been working with our retail team to think about how we measure and monitor and drive that in the months and years to come. And then the other piece is, of course, IT. So Raj and I are going to be working hard to see this flatten off. I'm not sure it will flatten entirely immediately. I'm told that I'm not allowed to give predictions, so I better stop that sentence there. But we want to see this as a flat line going forwards, and then a declining line there in due course. So the ratios around impairment improved. We did some write-offs around Mauritius, domestic, and also our Indian operations, which of course fall within SBM Bank Mauritius. Notwithstanding the fact we got a wholly owned subsidiary license granted last year, that's not yet operational, but should be in the second half of this year. I think the interesting thing for me about these figures is not the figures themselves. It's having been through them in some detail with Quan, who's our head of risk, and also with Raj. I am comfortable that what we've done is sensible and prudent provisioning. So no one has been saying, oh, what's the very least we can get away with? And certainly with some of the legacy clients, we were immediately in January, February in the place, so well, let's just get this cleaned out, because actually we've got a business to carry on building here, thanks. And the last thing you want is problems stored away for the future. I said earlier we'll do a review of segment B to make sure that as we continue to grow there, we've got the right risk standards. We'll do a bit of a review of our end-to-end credit risk management. And as we grow as a wholly owned subsidiary in India going forwards, we will also have a review of the risk strategy for that business, because I'm conscious, for those of you with long memories, that we did a dash for growth in India back in 2010 to 2012, and we've been paying for it ever since in terms of impairment. So we're not going to do the same again. So we will have a slower growing business, but a more stable, a more diversified business that is there for the long term. Our capital adequacy ratio remained well above regulatory requirements. I think that's a headline that is well worth just reading verbatim. It is important. It's important to us. Obviously, we want to remain well above the minimum. So some of you will have seen the Moody's report in November that said declining capital adequacy is a credit negative for SBM. I agree with them, but of course for analysts, you want to see the highest capital adequacy you can together with the highest return on equity, and we have to strike the right balance on that. So I'm happier at this level than where we were a couple of years ago, but we want to make sure that we maintain a sensible buffer going forwards, and we will be working to do that in the very near future. You saw that we retained a little over 50% of our earnings in terms of Tier 1 from last year's profits as well. And you'll see that from a decent dividend yield, but also not growing over the year, because we want to make sure that we're keeping Tier 1 strong enough for growth. So, share price. I didn't realize until I saw the first draft of this presentation that I actually had to talk about the share price over the last year as well. So let me touch on it and kind of conjecture as to why it's done what it's done. And I may be completely wrong. I'm a newcomer to Mauritius still. I'm a newcomer to this bank. But as a newcomer, there are a few things that strike me. So earnings per share have increased. That's great. It's a steady increase. That should generate good market sentiment. And I think you all saw a little jump in the stock after the results were announced. But performance over the last year has not been great. So I think continues to be subdued means has not been great. And why is this? Well, I don't know the reasons. I suspect most of you know the reasons better than I do. But looking at it as an outsider, I would say the speculation about 6-7 weeks ago about a potential possible Indian client of ours being in difficulties didn't help. I think if you're an outsider, you look at the rate of growth of loans and advances and you wonder if it's safe and secure. You buy a bank out of receivership in Kenya and you would have a question mark as to, can you make this work? You look at our internet banking offering and you say, what we had prior to the relaunch in March was frankly not fit for purpose. I was almost in tears when as a customer I started to get used to our internet banking offering. I'm hoping there'll be tears of joy by the end of April, Chairman, but they certainly weren't 6 weeks ago. Well, you did tell me that I should say it as I see it. And then the kind of overall riskiness and the Moody's report were all factors I'd see as weighing negatively on the share price. And it's my job, working with my colleagues on this table and throughout the organisation, to make sure that we are not taking disproportionate risk, to make sure that we have a strategy to grow in Kenya and in India that reflects long-term shareholder value, that builds a steady, well-diversified book and a stable and growing deposit base, that proves that actually in Kenya we can build a successful and scalable bank there. And as I say, with regards to the India book, I think that is by and large history now. The India book does not worry us in the way that, say, it worried my colleagues a year and a half, 2 years ago. So we won't repeat those sins, and the easiest way not to repeat them is to be really blunt with ourselves about what they were and make sure that is the case. That is my take on the share price and why it is where it is. I would hope that as we go forward, as we prove that what I'm saying is more than just fine words, we prove that's what we're doing, that actually this will change. And that actually we will get credit for being able to show continued growth and a prudent, well-managed business. So we talked about the dividend yield remaining strong. It is one of the leading payers. I say that with pleasure because as of yesterday, I am a shareholder in the organisation. I was in closed period before, so couldn't be before. So first opportunity I really got, I did. And I look forward to that dividend yield both holding up and growing over time as we prove the truth of what we've been saying. And a PE ratio that is very attractive to investors compared to the market if you believe the story we're telling. I believe it. I've put my career where my mouth is. I've put some of my money where my mouth is as well. So that's my investment in believing this. And I think at 7.5 times, frankly, I couldn't see any reason why I wouldn't buy based upon the knowledge I've gained over the last 2.5 months. So that's the financials. Let's look forward a bit and talk about what we're going to do overall and in different countries. Overarching priorities in terms of how we think about this and how we work together as a group are really to work together as a group, to drive more synergies, more linkages between the different businesses. And I will throw it open in a few minutes to my colleagues to talk about how they work together in bancassurance, how they work together in various other areas in terms of driving benefits for our clients. It's about building safe international businesses. And building international businesses takes time because you have to learn the markets. I mean, we're advantaged in terms of Kenya on the grounds that I used to cover Kenya amongst other countries, well, on 3 separate occasions with 3 separate employers. And this is only my 4th, so I think you can work out how long that's been. And Chris actually lived in Kenya and ran a business there for some years as well, so it gives us more knowledge as well. We want to use the balance sheet better. I referred to cross-sell and liabilities gathering in segment B. We do not want to be what a friend of mine would refer to as a dumb lender. So we will not lead with the balance sheet and then not follow up with cross-sell. We want relationships and we want them to be deep and broad. We will cross-sell the group, which is inherent in what I've just said, and we will have a strong discipline about cost management. That means that we won't kind of overpay today and then have to cut back tomorrow. We want to be disciplined day in, day out, so that actually we provide continuity to our people, to our stakeholders, and to our clients as well. And then we will have very strong credit management. Now, I know you don't see any of those up on that slide because that's our set of overarching priorities that applies wherever we go. That's how we want to do business. So that underpins what we stand for, it underpins who we will be. In Mauritius, I'll steal Raj's thunder here. Retail banking is about digitalization. We've talked a bit about that. It'd be good to touch on that more in question and answer. It's about cross-selling. It's absolutely about improving levels of customer service. I have had good customer service here and I've had bad customer service here, both from the same bank. I'd like it to be more uniformly good. I used to work for a bank some years ago where I was out with a bunch of senior people and I was relatively new. And I worked in the wholesale bank there. And I said over a couple of drinks with my colleagues, well, I've noticed you never recommend to clients that they bank with the retail bank. And one of them turned around, I'm not sure he was entirely sober, But he said, well, that's because the service is so dreadful, it would put my relationship at risk. And we can't afford to be in that place. So good customer service for us is really important for our customers. It's really important for our reputation. And it's really important for our client acquisition. Because actually, when people talk about what you do and they talk about it and praise you, it's a great sales pitch and one you don't have to make yourself. And we talked about reducing cost to serve, corporates, process efficiency, and moving up the value chain again, as we've talked about. So, international banking, we've talked about this a little bit. Leveraging the international presence. We're at that inflection point. We're not a single country bank, and we're not yet a dynamic, well-diversified regional bank. So we need to grow to become a well-diversified regional bank whilst managing the risk inherent within that. But it is within our reach. So it is not as though we're starting solely from Mauritius and saying we need to diversify. We know what we need to do. We have many of the people to do it, and we have many of the pieces of work underway to achieve it. It's about making sure we do it properly. Product and market diversification, I think, is important in the private banking and wealth management space because historically we've been quite vanilla in terms of what we offer here. We can do more. We can offer our more sophisticated clients better ways to protect and grow their wealth. We need to think about how we do that, always bearing in mind that what we offer must be appropriate. Because actually doing the right thing is really important to me, and it's really important to all the colleagues I've got in this group who I've talked to. And that's one of the things we would never compromise on. NBFC, again, if you want to come back to this, you can ask questions of Chris in a couple of minutes, but really exciting progress over 2017. So market first in terms of Frexim depositor, receipts, etc. Building synergies with other parts of the group, and maybe you'll talk in Q&A a little bit about investment banking, where you want to go with that. That would be quite exciting, I think. I've told you what we want to do in India. We want to build a well-diversified, stable, growing business with a low-cost, diversified funding base. And that's what we're setting out to do. We won't just give up on the impaired asset, which is the final bullet point. We will seek, as we have done so far, recovery from people who owe us money. But the really important thing for us in India is not to repeat what was done in the past. Kenya, stabilization and integration. And I know it says subject deal completion. Let's be clear about Kenya. We have a bank in Kenya. We have SBM Bank Kenya. And that is a small operation. It is the old Fidelity commercial bank. That's a small, good operation. Team has spent a fair amount of time over the last few months on clean up of that, tidy up, setting it up for the future. There's still more work to do about that. And then there's the potential Chase deal that has been in the press a lot recently. So integration really comes into play when that Chase deal happens, assuming that it does. And we're not assuming that is a given. We'd like it to happen. If it doesn't, we're already in Kenya and we'll simply continue to grow and sort out the organic growth there. We do need to understand that one of the really exciting things for us, and the Chair and I were talking about this yesterday, for Kenya, India, Mauritius and Madagascar, is getting the synergistic opportunities within the group, which is a dreadful sentence, but hopefully you all know what I mean. It is about the flows from India to East Africa. It's about the flows from Mauritius to Asia, the flows from Mauritius to Africa. And it's about having that relatively small but important network. And I was delighted when I'd been here about 3 weeks to be talking to our chief executive in Madagascar, who is doing business with a Kenyan corporate customer of ours in Kenya, so here, who is expanded into Madagascar and is doing the business in Madagascar. And we got that business because we're present in Kenya, we're present in Madagascar. We can help in a way that other people can't. And it's seizing those opportunities and building on those that gives you the deep customer relationships that are important. And then you'll see the final rider there about aligning to our risk and finance policies in Kenya. Madagascar, we should be bigger, in my opinion. And obviously this is not something we've taken to the board. We should be bigger and doing better in Madagascar than we have been. The strategy team are working with the Madagascan team to work out what that means and how we do it. And then when we have an answer to that, we will go to the board and present to them on what we think we should be doing and seek their approval or challenge on that basis. But notwithstanding what we report on Madagascar, I think it's important to note that we're helping our Mauritian client base who are doing business in Madagascar. We're accompanying them there. We're helping to build the strength of Mauritian companies by doing that. And we are all delighted by the fact we have a number of Madagascan clients who kind of do business with us here in Mauritius as well. So when you look at the Madagascar results, as I first did, and you go, really? Is that all? It's actually only part of the story, because it's the story of the entity there. It's not the story of the linkages that we have. For those of you who thought that I'd already gone on too long, don't worry, I'm within 3 slides of the end. But they are probably the 3 most important slides, because I've talked a little bit about what we did, I've talked a little bit about what our focus is, but if you don't get this stuff right, we won't achieve any of it. So it is about people. It's about upskilling our people. The chairman talked about our training centre. I'm pretty pleased to be part of an organisation that has a centre like that. I spent some time yesterday with our head of learning, talking about not just technical training, because everyone needs technical training, but about her plans for leadership training as well. So we develop people in terms of as their careers develop, we help them to take new opportunities. We were talking about what are the sorts of skills, what are the sorts of experiences people should have in order to be senior leaders, in order to be able to cope with Runningbacks, which is what my colleagues do. And that's really good. And I think that's an element going forwards, like moving people from contracts to permanent, like getting the values of the organisation right, like getting career progression right, like getting succession management right, that gives you the right culture. That's pervasive, and that changes your reputation in the market. So recruit, retain and reward top talent is actually an outcome of the other things, because most people don't come to work for you for the money. The money is important, but if they don't like the place, they won't stay. We want this to be a place where people are going, I really want to work there, because that will be a huge differentiator for us. We've talked probably too much about technology. We are doing quite a lot of stuff in the digitalization. I used to say digitization, but my CIO told me that was frankly wrong, and I needed to get with the program. And we need to manage IT costs and the cost of change, as we've talked about as well. We do have a relocation of our data center in India that we have to do this year / early next year, and that's really important to us. That will involve a significant capex spend. So when I'm sitting here in a year's time, please don't think that I misled you. I want you to be clear, we will spend on that, but it's about the ongoing costs that we manage and manage them appropriately to the channel. We are developing our group organization governance structures, and it says to enable accountability and synergy. It actually means to facilitate working together. So I want everyone in a leadership position in this organization to be focused upon the success of SBM Group, not focused upon their own role in isolation or their own entity in isolation, their own division. So more and more we will seek to reward people for how they do things, how they behave, as well as what they do. Then risk management. I think I've talked enough about this. I mean, we're pretty clear about what we need to do in that. I think we're doing a lot of the right things. We just want to make sure that doesn't change, really. And with that, I finally get to stop talking and hand it back to you. In summation, I think last year was a good year. We took some of the pain in terms of impairment, which leaves us cleaner and better off going forwards. We grew profit after tax by 11.5% after taking that pain. We had an outstanding performance in terms of financial markets, but we're not reliant on it, so we're not a one-trick pony. We are a broad, well-diversified financial services group with, in my opinion, a lot of potential. So thank you to my colleagues for all that they did. Thank you to you for listening patiently, and now you can open it up to Q&A. Thank you.
Okay, we open the floor for questions. So as usual, identify yourself and then put your question, and you'll get a reply from the Group C and supported by the 2 Cs.
I had a question with regards to the operations in terms of the trading desk. So we've seen, a big jump there from 500 million to almost $1 billion. How sustainable is that going forward, and what sorts of trading of sort of what types of securities are you trading there?
Perhaps I could hand that over to PV and Vimel to talk about because you will hear it from the horse's mouth.
We do business in mainly two asset classes. That is, one is currencies and two is interest rates. Since till 2016, from 2015 to 2016, we were active on interest rates. We were one of the first banks in Mauritius to do secondary market in bonds, both dollar bonds as well as MUR bonds. But in 2017, we have set up a state-of-the-art derivative desk in Mauritius. Derivative desk is headed by Vimal Teju, who is head of derivative desk, and with 4 dealers in derivative desk. There are 5 dealers. So we are trading on derivatives. It's not totally speculative trading. It is 90% of the income is from corporate income, customer income. Around 10 to 10% is trading income, banks speculative trading income. So we do almost all types of derivatives now. And the derivatives we do are options, interest rate swaps, currency swaps, credit default swaps, and structured products around these products. The main jump in income is on account of meeting the large corporate customers' requirements. So we did not offer these products in the past years because we didn't have the capable staff for offering these products to these customers. So we have in a big way our head of sales joined from operational banks to SBM, and the head of derivatives came from Commerce Bank to SBM in 2017. So we all together, so we are able to achieve a big jump in derivatives.
Can I add something on what PV has said? I would break this treasury performance into 5 pieces. I'll start with the first one, which is the merchant deals. I think what the new team has done is, I won't go into absolutes, but I'm telling you relatively, with the new team, and we had lost a lot of market share. So we're not really taking care of the market. When the new team came, the new sales team in treasury, we increased our market share in merchant trades by 10%. It's not insignificant increase. That's the first thing that this new team has done. Secondly, we became a primary dealer. And being a primary dealer and being a smart primary dealer, we made money on this. And I think we don't have to hide behind this because we're reading the market properly. The team has been reading the market properly. And the primary dealership also has brought some money to us. And then we have a very good bond trading desk, which has been one of our fortes over the years, and thanks to PV and his team. And the fourth one is where we've made the real mark on the market, is we've started providing risk management solution to our clients through Vimal and his expertise in derivatives, helping our customers to hedge their currencies exposure much better. And this is where we've made leaps and bounds. And finally, we have a small prop desk also, like all banks, but this is not the biggest piece that we have in treasury. So these are the 5 elements that have significantly added to the income of the treasury. And as both Andrew and PV have mentioned, the volatility part of this income is much lower than you would imagine. So there's a core stable income that is coming from the treasury, and my request always for PV is to give more, and he says, no boss, we have to be careful. So we are growing at a stable space, but looking at stable income rather than volatile income. I must also say that there are significant, I think Andrew touched on it, but there are significant areas where we can improve. The improvement for this year in 2017 has been basically domestically driven. There's a huge room for improvement in terms of forex trading between India, Mauritius, Kenya, Madagascar, which we have not fully exploited. And when we're talking about cross-selling, one of the areas that we need to really do this year is leveraging on those presences and increasing these cross dealings. And this is where we could really improve on the stable income coming from our treasury, as I would say group treasury rather than domestic treasury. Thank you.
So basically, I won't expect to see volatility on those figures in coming years.
Well, some of it's demand-led, and there's a little bit of volatility at the top and the kind of prop bit, but the core of it, absolutely not. Do we want Vimal to just say a word or two about the exact types of derivatives and how you handle them, how you back them off? It's worth it. I know that the word derivative normally makes people nervous. I think the more you hear from us on this, the less nervous you'll be.
But let me introduce Vimal to you. Vimal used to be the MD of Commerzbank in Dubai and in Singapore, and he had a rich career. And fortunately for us, he decided to come back to Mauritius, and we were fortunate to have him within the SBM family. Thank you for joining us and for making a difference. So I'll leave it to you now.
Thank you. Obviously, I wouldn't be able to do that without my team and the support of management. So basically, I think derivatives, I think it has a bad name throughout the world. But what we do here is very simple. When I came here, when we started looking at what our clients needed, it was extremely simple. What was strange is no one was really offering it in the way we are doing. So, as P.V. mentioned, the derivatives we do is very simple, basic. It's nothing complex, because obviously our corporates here, we don't want to do very complex stuff. So this is where we started. Very simple FX management. We're providing hedging solutions to our clients. So that's mainly what we're doing. Thank you.
Good afternoon, I'm Vij Bini from PSG Wealth. I have a question concerning your IFRS 9 and when will it be applicable to the bank? And I would like to know whether you figured out how you're going to treat the future provisions and the past provisions with respect to IFRS 9.
You want to? Yeah, I think Anita.
Anita, are you around? Yeah. So, yeah. I think we'll leave the experts to deal with this. But we're not too worried, just to say, on the broad terms.
We've already calculated our IFRS 9 provision. The ECR calculation has been done. We have already included in our financial statements the impact. It's not that much. We should be happy about it. In terms of future calculation, the impact again won't be that much because we have the Bank of Mauritius guidelines which we need to take care of and abide to. So not much of impact even in 2018 or in 2017.
Sorry, I forgot to introduce Anita. Anita Kilawan, Head of Finance within SBM Bank Mauritius.
And on the retail, well, you've spoken about cross-selling on the institutional and corporate side, but on the retail side, how do you expect to cross-sell your products, and especially between the banking and non-banking segments?
I think it's pretty much the same. So corporate is in some ways easier because it's a deep and broad relationship with your corporate clients. On the retail side, I mean, I grew up in the UK in the 70s and 80s where banks just pushed product at retail clients. That's not appropriate. That's not the way to do it. But clients do need a range of services, and it's our job to identify that and help clients get the right range of services. So Shailen has been working with Raj's team on this. And Shailen, I'm going to actually hand it to you for a second. Just talk about how we're starting to align cross-selling with reward, etc. So do you want to spend 2 minutes? So Shailen is our head of strategy for the bank and for the group, and is driving this. And then maybe back to you, Raj.
Yes, thank you, Andrew. And I think in terms of cross-selling, as Andrew has mentioned throughout the presentation, is something that we're putting a lot of emphasis across our different entities and our different geographies. And how we want to make sure that it happens is that we've included that in the reward process. So for every head of, every chief executive, the performance of cross-sell is going to be one of their KPIs. And even this will trickle down to the department heads and individual employees of the group. Right. So I think this is how we are putting it in the system. But the way we are going to do cross-sell is there's a mix of quite a few things. So if we go to the more, let's say, sophisticated level, it's tied up to our data analytics initiative, which is also one of the strategic initiatives we're pursuing. And if we look at it from the more simple perspective, is around referrals and the simple stuff that can be done. But basically, it's around meeting the client's needs. It's about fulfilling the financial needs of all our global customers as a one-stop shop.
I'll go to the basics. We've been, in certain sense, very, as Andrew told me on his first interaction with me, he said, Raj, you're a very plain vanilla bank. And it's truly the right way of addressing the way we've been trying to do business here, take deposit on one side and giving loans on the other, which is plain vanilla banking. We failed to ask, do you have do you want an investment product? Do you have an insurance? Would you like other product that we can serve? It has not been in the DNA of the bank so far. This is the problem that the bank has been facing historically. There have been timid movements in doing this, but we've not been very successful in doing that, honestly. So this is where the cross-selling drive in the retail is. Now we're asking, we've put the structure now. We have an NBFC, non-banking services that we have to sell to our retail base. We have to sell to them investment products. We have to sell to them insurance products, and we are putting KPIs and rewards attached to each unit and each department so that we maximize on the interaction with our clients. Well, the basic indicators is wallet share, and that we need to measure along with customer analytics. So now we have the capabilities of having a non-banking, and we have the customer base, so everything is set to be able to reap on what we have. So on to Chris.
Well, I'll briefly say that we are adopting an approach of investment advisor to our clients. Within the NBFC and in line with the FSC regulations, we have got a number of licensed investment advisors in our team. And these investment advisors are working in close collaboration with the private wealth, private banking relationship managers, whereby we are doing a profiling of our clients, and based on the profiles that we establish, we schedule meetings with the clients where we have both the relationship managers and the investment advisors who are present. We present our analysis to these people, and then we present the different range of products that we have, and we allow them to make a choice based on the full information that we give them, and advise to the extent that we can advise them. You are aware that we have a number of investment products. We have different investment funds, rupee funds, dollar funds, some funds which are investing only in equities, others investing exclusively in fixed income securities, and we have balanced funds and mixed funds as well. So we present all this to our clients along with both the relationship managers and the investment advisors, and this is how we have been helping our clients to increase their income on their investments rather than having their money just lying in savings accounts or term deposits. We are offering them a much wider range of products, and that has been reflected in the growth of our assets under management within SBM Asset Managers Limited.
Andrew, earlier you mentioned moving the servers, and you've got a large capex coming for that. I was just wondering why the need to move the server, and where is it moving to?
Well, it's not the server. Sorry, well, it's the data center. So we've got a data center here. We've got one in India as well as part of the IT build-out, and we need to bring data back to Mauritius from India. So we're working on a project. Now, I can't say how big it'll be at the moment. We've got a figure in the budget, and I am 50% confident that the figure will be below that, significantly below that, actually, if we get our plan right. But it is about bringing data ownership back to Mauritius, which is important under guidelines and regulations. And my biggest concern is working with Raj and Samir. I don't know if Samir's here. No. Samir's our CIO, to look at the plans and make sure that what we do is risk-free insofar as any transition of a data center is kind of risk-free, so that it's seamless, we've got the backup in place, and there's no customer disruption as we do it. So, sorry that's a bit of a woolly answer. It's coming from India to data ownership back here. The phrase is data ownership here. You might not necessarily do everything here. That's something that we're talking to the authorities about, what is appropriate and what is the best way to do that. But it is something that we will need to do. We have the figure in the budget, and I'm confident that I haven't said anything in terms of growth and capability that would go against that, and I think there's upside from getting it right as well.
Yes. And if I may,
please.
Just to mention that we're looking at different options: full physical, full cloud, hybrid cloud, hybrid options. So there's a lot of discussion going on at the bank level, so that we have the best option possible in terms of security and risk and in terms of cost effectiveness.
Because in common with most regulators around the world, and I've seen this in a number of jurisdictions, our prime regulator is asking that data ownership reside within Mauritius. And at this moment in time, under the rather exotic bird that the chairman referred to several times in his introductory remarks, data ownership does not. That is not acceptable, and that must change. We are conscious of that. We will absolutely abide by what our regulator tells us to do. As Raj says, we've generated 4 different options for how best to do that, and have said to the regulator we want to talk through with them, work out what is most appropriate and what is best in terms of risk and cost. And it's in that order: risk, then cost.
Would like to invite other people to ask questions, please, because we've had questions from only 2 persons, and either you all.
Thank you very much to both of you.
And I think you're all waiting for the refreshment, so we're ready, if you're ready, but we'd like to have questions from others as well. Sorry, Bhavik, but we need to get others to talk to.
But if they don't, you can ask another one.
Please, feel free.
If I'm not mistaken, I think that the data center was in Mauritius in the past, then was transferred to India. And then now it's being transferred back to Mauritius. But do you have the capabilities, I mean, in terms of IT expertise, to manage it here, or will it be like an additional IT or personnel cost?
Well, as Raj said, and I then reiterated, we're looking at 4 different options. The phrase I used was data ownership in Mauritius, because that's an important point. It doesn't mean full physical here in Mauritius. So you need to think about what those options meant. Raj referred to full cloud, hybrid cloud, full physical. I can't remember what option 4 is off the top of my head. All of these have different ways of manifesting in terms of personnel requirements, in terms of data, in terms of customer service, in terms of security. So what we're trying to do is get the lowest risk across those dimensions, and then obviously at a manageable cost. Will it drive up our operating costs? I don't think so. None of those options materially drives up our operating costs. Do they have different capex implications? Yeah. Can we make all 4 of them work? Yeah, we can actually. So is it a risk to our plan and our reasonable confidence in our continued growth? No, it isn't. But it is kind of one of the first big things where we can change the shape of what our IT space and configuration looks like, we think, for the better. So it's an opportunity, but it's one we need to get right. Second question inherent in your first question is, do you have the ability to do the transition, I think? Not just can you manage it at the end, but can you manage that transition? And that's a question that Raj and I also asked. So we've just been through an RFP process that Anita, who spoke earlier about IFRS 9, oversaw with Kavi as well. Kavi's over there. To actually hire a consultant to help guide us through this process. And this is a consultant who does advisory work, whose reward is tied to our success, who is not a retailer or wholesaler of products. They have no incentive to kind of sell us anything. And the better we do, the better they do. And we've been very careful to grow on our experience of the last several years to make sure that actually incentives for people we use are aligned with our interests. And that's a change for us.
Hi, I am Niraj from Swan. Question for you, Andy. You talk a lot about the share price. You know, dividend yield is a very good thing for us as an investor, but at the end of the day, what we look like is return on equity. And to compare like with like, if you look at your biggest peer, SBM is still a bit lagging on that stage. For you, I would like to ask you a question. If you are looking down the road, let's say a 3-year plan, what would be your idea, the figure you would like to have SBM bridge? That's my first question. We actually the second one when I have the mic in hand. Is when we look a lot about your strategy going forward as the new captain on the ship, and a lot of the operation now seems to be going forward to come out of Mauritius. And if I were to take that cake and split it between segment A and segment B operation, how would I look at that pie chart? And if I take that segment B, where will you see that drive coming? Would you see it come from Africa, Kenya, or maybe India side?
The problem with being as long-winded as I am is you inevitably forget question 2 by the time you've answered question 1, which is why I was scribbling some notes. I think the ROE question is actually quite a hard one, because intuitively you should be able to chuck out a range of figures and people go, oh yeah, that makes sense. Shailan and his team have been doing some work on this for us recently, and we took some figures to the board last week. The reason why it's hard is, of course, if I give you a figure, it's a bit of a blend, because it's a blend of Mauritius, banking, Mauritius NBFC, India, Madagascar, and Kenya. Most of which, excluding Mauritius, are not significant today, but we would wish them to be so in due course. So what we've done as an approach to start to hone our performance management is we've looked at what top quartile performance is in terms of return on equity and a number of other measures in each of our individual markets. And then we are starting to target our businesses on how they get to be top quartile performers. So look, if you start off with a loss-making bank in Kenya, you don't switch overnight to be a top quartile ROE. But you can set in train certain strategies that will get you there over a 3 to 5 year period, and that's what we're intent on doing. In India, our 3-year plan for India shows a return on equity that's still single digits. I think I'm allowed to say that. I don't think that's really guidance. Which isn't good enough. Now I could ramp that up a bit further by going a bit faster, and then we could pay for it again in years 4 and 5. What I want us to do is be cautious enough to learn these markets before we charge in too fast. So what we can do separately, Shailan can kind of walk you through that work. Do you want to spend a minute talking about this? And that then gives you a blended ROE, which I don't know what the figure is. It feels like it should be 15 to 20%. Shailan, do you want to talk about that? And then I'll come back to the second question, which is segment A, segment B, and international, I think. Whew. Sorry.
Sure, and I hope I get the figures right. Don't
more likely than me.
Don't take the figures at face value. But I mean, if you look at the different markets, and if we talk about ROE as a benchmark, if you take the better performing banks, for India, for example, you would be looking at an ROE of between 15 and 20%. Similar as for Mauritius, but in Kenya you could be looking at an ROE of around 25%. Same for Madagascar. Some of the banks are actually doing better than that. Now, if you look at the blended ROE for India, for example, for the whole banking sector, it's much less than that. Because many of the, like 70% of the banking sector in India is public sector banks. And public sector, as you know, is not doing very well in India right now. So when Andy was talking about the blended ROE for the group, for SBM Group, it's like the share of what we have, of the business we have in these different countries, multiplied by the ROEs that I've given to you. Now again, it's not overnight that we're going to shift from negative or 0 to 15 or 25% in India. Similarly in Kenya. So that will take, depending on the amount of, on the stage we are at, on what we have to build in terms of skills and capabilities, it might take 3, 5 or 7 years in these geographies. but I guess that gives you a pretty good range of where we are trying to be. Now, what we've done also, we've said that we don't want to, obviously we have our internal targets, but we don't want to change the benchmarks because we think that it will distort the process. We'd rather say that it's a journey that will take such and such time. Maybe the time taken for each country will be different, but eventually in a steady state, that's where we plan to get to.
So let me come back to the second question. I want to be pretty clear. When you say new captain, we already have a strategy in this group. It's a pretty clear, simple strategy endorsed and set out by the board a couple of years ago. So a few people have said to me, when will you set out the new strategy? To which I've said, there isn't going to be one. What we're going to do is we're going to make sure we execute on the one we have. I don't think it's terribly helpful for people to come into organizations that have a clear set out path and think they know better. What we want to do is make sure we execute well on it. So that's the first point. Second point is, where would I see the linkages, the international linkages, and then back to segment B? Absolutely see them where we have physical presence. So absolutely see the linkages with Kenya. When I say Kenya, I think you need to take Kenya as shorthand for East Africa. Because if you operate in Nairobi, you can operate basically across East Africa. It's the hub for East Africa. Absolutely see it in India, although I want us to be cautious as well in India. Many people have lost their shirts in India in banking, and I don't want us to do that. I do want us to build up further linkages, although they're relatively modest in comparison, but with Madagascar and then with other places in the Indian Ocean as well. So I'd like us to be seen in the years to come as kind of a premier Indian Ocean bank by people in the Indian Ocean, by a great linker and a great linkage by other people. So we link East Africa and India, and there are strong trading links between those 2 points. Raj referred earlier to doing more of the business there. And then other jurisdictions where we may not have a physical presence, but we see pretty strong trade links. We believe we can do good quality business in a prudent way. Or countries where we think we may, in due course, wish to have a physical presence. So what we won't be doing is going out and doing business all over the world in places that we can't spell, never mind understand. It will be more prudent than that. Does that answer the question? Pardon? I don't know off the top of my head. Raj, you got a view?
No, I think just to give you comfort that our segment B business is not dependent on the India DTA. That we can say for very sure. Our segment B business, be it in terms of liabilities or in terms of asset, is not very dependent on the India DTA. So we have no worries on that point.
Last question? A bonus? No? Nobody want to take it? Yeah.
One for the room.
If we don't have one, then we thank you for your presence and attendance as usual, and we invite you for refreshment at the back of the room. Thank you.
Thank you very much.
Dear shareholders, clients, and stakeholders in general, welcome to the SBM. As you know, since we have been put at the helm of the board of SBM Holdings, we have practiced a policy of transparency and accountability. We have every quarter called the press and business analysts to the headquarters of the bank to analyze the performance of the last quarter. And this we have been doing since 2015, every quarter. As you know, the results for this year, 2017, shows a growth in profit for the year 2017 of 11.5% to over 2.5 billion rupees. And the total assets of the bank also rose by more than 37% to 194 billion rupees. That is 5.8 billion US dollars. This result that is produced to the general public today and which has been advertised in the press shows that the bank is on course to achieve the targeted growth under its 5-year development strategic plan. The bank is a subsidiary of the group, and the group, as you know, has entered into a 3-pronged strategy, that is internationalization, digitalization, and lastly, diversification. So the group, as you know, has obtained a license to operate in the Seychelles. It has also acquired a bank in Kenya and will soon acquire, carved out good book of another bank in Kenya. And it will also be the first foreign bank to obtain a wholly owned subsidiary banking license in India. So our strategy of expansion is on course. The second pillar of our development is digitalization. As you know, we have introduced the mobile banking app. We have also put into our website online loan application and online credit card application and online bank opening facilities. We have also introduced various applications in our mobile and internet banking, which will make it possible very soon for the bank to offer 24/7 banking facilities, so that anytime, anywhere, through your mobile, you can do your banking transaction. The other aspect of digitalization is the partnership with the Chinese giant Alibaba. We are the representative of Alipay in Mauritius. So Chinese tourists coming to Mauritius can pay from their Alipay wallet to any local merchants that have acquired the Alipay system from SBM. And we are going to open up this Alipay payment system to Mauritian merchants, especially the SMEs, and to the Mauritian public. So this partnership with Alipay is a game changer for SBM, and the SBM will be soon a totally digital bank, the first one in Mauritius. And the last leg of our expansion is diversification of services into non-banking financial services. We have already stockbroking services, custody services, fund valuation and administration services. We have also factoring services, microfinance services. So we are introducing a range of non-banking services. And you also know that we are the first bank in Mauritius to obtain the investment banking license to operate the facilities of advisory services for M&A transactions, equity raise, and debt raising. So the bank and the SBM group in the future has taken all the necessary steps to launch its expansion, and the results already show that we are getting into the right direction for that growth trajectory. And we hope that with the support, continued support of our client, and with hard work of our staff, and with our talent retention policy and staff training initiatives that we are taking, we shall become a leading regional financial services provider in Mauritius and the region. Thank you very much.
Hi, I'm Andy Bainbridge, the Chief Executive of SBM Holdings, the Stock Exchange Mauritius listed entity that's the parent company of SBM Bank in Mauritius, in India, in Kenya, in Madagascar, and the NBFC here in Mauritius as well. And I wanted to talk to you a little bit today about our results for 2017 that we recently released. 2017 was, in many ways, a transition year for SBM Holdings. We obtained the first wholly owned subsidiary license in India and will be incorporating into a new entity during the course of 2018 there. A huge success for us. We acquired, out of receivership, Fidelity Commercial Bank in Kenya, renaming it SBM Bank, and going through a process of cleaning it up and setting it back on its feet for future growth. We entered into discussions with regards to the takeover of Chase Bank in Kenya, which again was another potentially significant step forwards for us. In Madagascar, we opened another branch, taking our total to 4, and we have plans to further grow that business. In Mauritius itself, where we have a significant market share in the domestic market, we made good headway in terms of further penetrating segment B and taking our market share up to 10% in that market. The NBFC successfully dealt with the Frexim depository receipts issue, a market first in Mauritius, and tripled its profit for the year at the same time. So that all sounds very exciting. What does it mean for our clients? What it means for our clients is that we are a full services financial sector provider. We offer ways for our clients to do business that are easy for them and provide scale to us. So what does that mean in terms of financials for last year? Well, we penetrated segment B further. We increased our deposits by significant double-digit numbers in Mauritius and also increased our deposits in India at the same time. We increased our loan book onshore in Mauritius, and we significantly grew our foreign currency loan book offshore in segment B, as I've referred to. All of that led to a healthy rise in both net interest income and non-interest income. We had further pain to take in terms of impairment, and we took the increased impairment charge, which has enabled us to get to a state where we're pretty happy that the book is now in good shape. All of this led to an 11.5% rise in profit after tax. And that meant that we maintained the dividend for 2017, ensuring that our shareholders got a 5.5% yield, and at the same time we bolstered our capital reserves by 1.7 billion rupees. As I say, a year of transition and a creditable year as well. So, with that done, what are our ambitions for 2018 and beyond? We will continue to grow in Madagascar. We're opening another branch this year, and we have further plans. In India, when we incorporate into the wholly owned subsidiary, we'll grow from 4 branches to a significant but still modest number. And we'll be looking to grow a sustainable retail and SME and mid-corp business there, building a low-cost deposit base, making life easy for our clients with new and enhanced IT capabilities which are coming along in May, and enabling us to offer services we previously haven't been able to. In Kenya, subject to the Chase deal going ahead, and it is in the public domain, then our work this year will be about integration, about building a bank that is set up for success in the future. In Mauritius, we have a different set of challenges, I think. We have a secure, sizable, capable, scale business onshore, the big domestic bank that people know through our 43 branches, through our 100 plus ATMs, through our 20,000 point of sale terminals, of which we're very proud. The challenge for us in this business is about really helping our customers to have an easier life, to provide a better internet banking service. We rolled out a new corporate internet banking service in March, and the retail version comes along at the end of April. We're all very excited about that. We recognize that what we've done in the internet banking space has not been of the standard demanded, which we seek to offer. We do think that that upgrade will complement our mobile banking app, which we think is pretty darn good, but there's more that we can do, and later this year you will see that capability come to the fore. We're looking to do more in terms of using our point of sale terminals and providing better ATMs. We want to increase our ATM uptime, enhance the service levels, and also provide more services. So not just better service levels, but more services available on ATMs. We have those on order now, and you'll see them rolling out over the course of this year. We'll also be upgrading and refurbishing some of our branches. And this is important as well to ensure our clients get the quality of service that they demand. Now, this sounds like spending a lot of money. And it is spending a reasonably large amount of money, but we're doing it for the right reasons. And the right reasons are investing in client service and investing in operational efficiency. We'll be looking to make more of our new computer system that went live in 2016 and to get some scale benefits from that as we go ahead. So we'll be managing our Mauritius domestic operations to provide great service and a lower unit cost. So cost efficiency and client service are the watchwords there. You've seen us now grow for 2 years in the international segment B business. We've grown the loan book, we've grown the income, and the challenge for us now is to grow the liabilities at the same rate and also to cross-sell other products into that client base to make sure that despite the narrower net interest margin you get on US dollar lending, that actually we're getting our fair reward for the risk that we take and the service that we offer. In the NBFC, they will have another successful year. They're targeting increasing assets under management and increasing the brokerage volumes quite significantly. We are in the process of hiring the people who will make up the new investment banking team as one of the first holders of an investment banking license, and we'll be looking to develop that service at the same time as growing our new factoring business that we launched at the end of 2017. So, a lot was done in 2017. There's a lot to do in 2018. What are my priorities? To support my colleagues as they deliver to our clients every day. To ensure we use the balance sheet more sensibly sometimes and more carefully to ensure we get the returns for our shareholders. To increase efficiency in the big onshore business in Mauritius. To ensure that as we grow in segment B and as we grow in India, that we are suitably sensible about risk management, that we have an end-to-end credit process that preserves the integrity of the book, and that we are prudent with our shareholders' funds and our depositors' funds, because we recognize we are a service provider, and that is what we're here to do. I'm really excited about being here at SBM Holdings. I hope that you're excited about our future as well. I think it's a really good one, so long as we carry on with getting the basics right and doing it day after day after day. Thank you.